Good afternoon, everyone. Welcome to our webinar on tangible property repair regulations and fixed asset review opportunities for 2022 and beyond. Our speaker will be the principal from our Dallas and Fort Worth office, Eddie Price. Before I turn it over to Eddie, I would like to go over some administrative details. KBKG was established in 1999. We have offices across the U.S., including Illinois, Arizona, Georgia, New York, Texas, and Pasadena, California, where our headquarters is located. We provide turnkey tax solutions to tax preparers and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of tax preparers across the country. I will now turn the webinar over to our speaker today, Eddie Price.
Thanks, Caesar. And hello, everyone. Before I dive into today's topic, I'll share a little bit about my background. I'm a graduate of Texas A&M with an undergraduate degree in environmental design, and my graduate degree is in construction management. I joined KBKG about 9 years ago to lead our Texas-based operations, and I do quality control reviews on both cost segregation studies and fixed asset reviews. I'm proud to say that KBKG is very involved in the American Society of Cost Segregation Professionals, which is recognized as the primary professional organization in our industry. We currently have 7 certified members of the ASCSP, including myself, and I serve as its chair of the testing committee, and I've been a past chair of the education committee. All of the cost segregation reports that I review at KBKG end up being signed and certified with my ASCSP stamp, which is a symbol of quality to anyone who might review those reports, in particular the IRS. I have 40 years of experience in the cost segregation industry. 20 of those were with a Big 4 CPA firm. So at the end of our tangible property regulations presentation, we will have covered all the bullets that you see displayed here. Most of what we're going to cover today will be presented from the standpoint of a taxpayer that owns a building or leasehold improvements within a building. We'll start out by discussing the unit of property and the 8 unique building systems that must be identified according to these tangible property regulations. Then we'll go over the definition of an improvement, and we'll step through the repair standards or the bar test as referenced in this presentation. We'll spend time talking through how these regulations apply to the evaluation of certain types of building components, specifically focusing on key areas within the HVAC and roofing components. We'll also demonstrate why it's important to recognize retirements. We'll look at some of the safe harbors that the IRS has included within these regulations. Specifically, I'll cover the routine maintenance safe harbor, and the safe harbor for small taxpayers, and the de minimis safe harbor. And finally, we'll wrap up with an overview of the retail restaurant industry safe harbor. The tangible property regulations are effective for all taxpayers for the tax years that begin on or after January 1st of 2014. I will note that there is an exception for small qualifying taxpayers, but generally this applies to everybody. These regulations were issued in their final form back in the fall of 2013. They were previously issued in temporary form back in 2011, and many of the more capital-intensive taxpayers were early adopters back then in 2011 and 2012. And in order to really take advantage of the tax favorable aspects of these regulations, they jumped in there early. In those years leading up to the final regulations, there were a number of practitioners out there that were suggesting that everybody would need to file Form 3115s, which I would argue is not necessarily the case. If a taxpayer or their practitioners felt that the current methods they were using were in compliance with the final regulations, then there was no need to file a Form 3115. The purpose of these regulations was to provide a framework for determining whether or not repair expenditures could be currently deductible or whether they might rise to the level of capitalization. Prior to those regulations, you might have a controller that would look at an invoice for $30,000 for a repair, for the spend for that, and assume that because that's a big number, therefore it has to be capitalized. And so they would capitalize it and depreciate it as an asset over its useful life. And then typically the tax department would just follow suit and capitalize it as well. These final regulations provide guidelines on how to analyze the facts and circumstances around a repair to determine the optimal tax treatment of those costs. The regulations provide over 200 examples that taxpayers and practitioners can then use to guide their analysis, and we'll go through a few of those examples later today. If a taxpayer determines that they do need to update their current method to comply with the regulations, then the Form 3115 does need to be filed. The good news is that this change is an automatic change. It's change number 184, and it does not require IRS consent to file. So you can just file the form with the appropriate Section 481A adjustment with your timely filed tax return and attain the benefits on the current tax return. Well, let me just go ahead and address an expectation that some of you in the audience may have about the distinction between a repair versus capitalization. You might be coming to this webinar expecting there to be some kind of a clear-cut answer to that determination. In reality, there are no bright line tests that the IRS has provided. It's very much dependent on the facts and circumstances that surround an expenditure, as I described in that previous slide. The regulations describe a concept that they call the unit of property. In order to properly evaluate our facts relating to any expenditure, we need to understand how the unit of property is affected by that expenditure. So let's look at some simple examples here. If we spend $30,000 for 5 new plumbing fixtures, where our unit of property is the entire plumbing system in a small 5,000 square foot building, we might assume that this should be a capital expenditure because the $30,000 is likely a significant cost relative to the entire plumbing system in such a small building. However, if you change the facts slightly, take the very same $30,000 expenditure for the very same 5 new plumbing fixtures, where the unit of property is instead the entire plumbing system in a large 50,000 square foot building, now we're more likely to conclude that this is a repair expense, as the plumbing fixtures would likely represent a very small portion of that total plumbing system. You see in our examples, the same items replaced require different treatment because of the facts and circumstances and how those expenditures relate to the unit of property in their context. As you think about the unit of property, one principle that you should begin to understand is that the smaller your unit of property, the more likely it is that your expenditure will need to be capitalized. Well, let's take a closer look at this term unit of property. If you think about it, an asset can have many component parts. However, a single unit of property will consist of a group of components that are all functionally interdependent. For the unit of property to function correctly, it needs to have all of its component parts in place. Another way of evaluating functional interdependence is to observe when the components are placed in service. If you would only place one component in service in conjunction with the other components, then you might conclude that those components are all functionally interdependent. There are special rules for different types of property. For plant property that's within a manufacturing process, the unit of property is further broken down into each component or group of components that perform a discrete and major function within the functionally interdependent machinery or equipment. It's a mouthful to try to talk about these things. Network assets include railroad track, oil and gas pipelines, water and sewer pipelines, power transmission and distribution lines, and telephone and cable lines. For network assets, there's industry guidance from the Treasury Department, and the IRS will determine the unit of property. But for this webinar, going forward in this webinar, we're going to focus most of our attention on buildings and the leasehold improvements within buildings, which covers probably 85% of taxpayers' questions and controversy out there. Within the context of a building, the entire building and its structural components altogether constitute a single unit of property. Now, there are 8 specific building systems that have been identified in the regulations. These include HVAC, plumbing, electrical, escalators, elevators, fire protection and alarm, security, and gas distribution. Everything else you can think of in a building would just be considered part of the building structure. Now, any quality cost segregation study should actually break out these systems for the taxpayer. In our example earlier about replacing plumbing fixtures, we compared the replacements to the entire plumbing system when determining whether it was a repair expense or should be capitalized. There's an example there of why it's important to have these systems broken out within the total building cost. For leased buildings, the unit of property is viewed differently here depending on whether you're the lessor or the lessee. For the lessor, the entire building constitutes the unit of property. And as discussed in the previous slide, the lessor needs to consider the basic building systems serving the entire building and evaluate modifications to those systems in that context of the entire building. But for the lessee, the unit of property is limited to that portion of the building subject to their lease terms. Any future improvements made to the lessee's space are combined into the existing unit of property under lease. The building systems must still be considered, however, only that portion that is within their leased space. The plumbing system in the lessee's space might be limited to break room or kitchen sinks. Perhaps they also have a dedicated restroom with associated plumbing fixtures that they're responsible for. In our example, a lessee in a large building remodels the dedicated restroom located in their space. If the lessee performs the work, it is likely going to be a capital improvement because work was done on a major portion of the plumbing system located within their space. However, if the same work were done and instead performed by the lessor, from the lessor perspective, it might be treated as a repair expense as it only affects a small amount of that entire building's plumbing system. Once the unit of property has been established, the next step will be to analyze that expenditure in relation to the unit of property using the repair standards or the BAR test, which tests to see if the unit of property has been improved and thus needs to be capitalized. According to the tangible property regulations, an improvement is any amount paid for that either 1, results in a betterment to the unit of property, or 2, adapts the unit of property to another or different new use, or 3, restores the unit of property. Again, if any of these criteria are satisfied, the asset is deemed to have been improved and it must be capitalized. Most work that's performed on a building is done, at least to some degree, to make it better. But does that mean it's a capital improvement? Not necessarily. We'll look at that further on the next slide. If we adapt a warehouse to become showroom space or convert a restaurant to retail space, we've changed the use of the property and the cost of converting it will be capitalized. We'll look at this on another slide. Finally, we'll also look at several examples from the regulations about what is considered to be a restoration of the unit of property. What is a betterment? Well, a betterment is something that corrects a material condition or defect. A betterment is a material addition, which could be an enlargement, an expansion, or an extension. For example, if you have a 10,000 square foot building and you add a 2,000 square foot warehouse addition, you've incurred a betterment. A betterment would also be a material increase in the capacity, productivity, efficiency, strength, or quality. So, for example, if you replace asphalt shingles with new high-tech solar shingles like you see in this picture, well, you've incurred a betterment. One thing to keep in mind is the fact that technology is always improving, and sometimes it may be difficult to replace a component with one that's truly comparable. If you're replacing your 20-year-old HVAC unit, I'm pretty confident that the energy efficiency rating that you're going to have today that's available to you will be far better than the rating you had on your 20-year-old unit. In situations like that, the new unit isn't necessarily a betterment. If you're replacing a builder grade quality unit from 20 years ago with a builder grade quality unit today, it seems very unlikely that you would have a betterment. Although we're focusing here on material change, the IRS has not really defined what materiality means in this context. So it's still our responsibility as practitioners and taxpayers to analyze those facts and circumstances and compare them to the facts that are outlined in the numerous examples provided in the regulations. And as mentioned earlier, there's over 200 of these specific examples that are provided by the IRS. So there's a lot to compare to and potentially find some comfort in what our position is going to be. Now we're going to touch on the adaptation standard. If we incur cost to adapt the unit of property to a new or different use, then we need to capitalize those costs as an improvement. In our example here, the taxpayer is converting a manufacturing building into a showroom for business purposes. The scope of work seems rather typical of the kinds of things that you might otherwise think of as a repair expense under other circumstances, but this change of use is triggering the need here to capitalize this work as an improvement. If they replaced lights, painted the walls, and replaced the other components as part of their ongoing manufacturing operation, well, these very same types of items might qualify as a repair expense, assuming all other requirements are met. The last repair standard is the restoration test. In order to have a restoration, at least one of the following events must have occurred. First, a restoration could be an amount that you paid for a replacement of a major component or a substantial structural part of a unit of property. It could also be an amount paid to return the unit of property to its ordinary operating condition if the property has deteriorated into a state of disrepair and is no longer functional for its intended use. It could be for an amount paid to rebuild the unit of property to a like-new condition after the end of its class life, which is basically the same as its ADS recovery period. A restoration could be for the replacement of a component of a unit of property for which the taxpayer has properly deducted a loss or taken into account the adjusted basis in realizing gain or loss resulting from a sale or exchange of the component. And finally, a restoration could also be the amount paid for the restoration of damage to a unit of property for which the taxpayer is required to take a basis adjustment as a result of a casualty loss or relating to a casualty event. There is a lot to unpack with the restoration tests. In our previous slide, we referred to replacements of major components of a unit of property meeting the restoration test. A major component would be one that performs a discrete and critical function in operating a unit of property. Examples here might include the lighting system, air conditioning, flooring, and so on. But a substantial structural part is a part or a combination of parts that comprises a large portion of the physical structure of the unit of property. For example, if more than 50% of the lighting in a building is replaced, then a restoration has occurred. Although the final regulations don't provide a bright line test for determining whether a replacement of a major component or substantial structural part is a restoration, the examples they provide within the regulations lead us to understand that the IRS does not consider the replacement of 1/3 or less of a unit of property to be a major or substantial replacement. It is important to note that an incidental component generally will not constitute a major component, even though it may perform a discrete and critical function. Now, the obvious example here would be the thermostat within an HVAC system or a light switch within the electrical system. They're small, they're inexpensive, but they're critically important in the operation of the system. In the final regulations, the restoration standards must be applied to all major components of the building or unit of property. So, step one is to identify the major components within the building system. Step two is to determine whether a significant portion of a major component was replaced. In our example, we describe an office building HVAC system where there are 3 furnaces, 3 AC units, and the associated ductwork for these units throughout the building. If just one of these furnaces breaks down and is replaced with a new furnace, do we have a restoration? Well, the 3 furnaces together perform a critical function of serving the HVAC system and would together certainly comprise a major component. However, replacing only one of the 3 furnaces is not considered by the IRS to be a significant portion of the major component. Therefore, it passes the restoration test, and assuming all other tests are satisfied, this very well could be a current year repair expense. Let's look at another restoration example. Suppose we replace the chiller in our building, and it's the only chiller in the HVAC system. That's not unusual. In that case, we've essentially replaced a major component that's performing a discrete and critical function because the system becomes inoperable without that chiller. Notice that we replaced the chiller here with a comparable unit, so we don't have an issue with the betterment test, but we fail the restoration test and therefore have to capitalize that new chiller. On the other hand, assuming the same facts except that the replaced chiller were one of 4 chillers in a really large HVAC system, in that case, we might consider it to be a minor component and treat that chiller cost as a repair expense. And chillers can be very expensive and significant, but in that case, because of those facts and circumstances, it still could be a repair expense. Here's another HVAC example. Here we have 10 rooftop units that serve various zones in our building. And due to climate control problems in some of the offices, we decide we need to replace 3 of those units. It's obvious that 10 units would comprise a major component of the HVAC system. However, 3 units are only 30%, so not a significant portion of the major component. The 3 units are also not a substantial structural part of the HVAC system. So therefore, the replacement of those 3 units is not a restoration, and assuming it's not a betterment, the expenditure could be deducted as a repair expense. Now, some of you might be wondering about the provision under the Tax Cuts and Jobs Act for treating items like this as an expense under Section 179 and whether it would apply here. The answer is yes. It absolutely would apply, so that is another option to consider. Even if you've replaced all 10 units, you could still take the 179 expense deduction. Let's say you've already hit the cap on 179 expense, so that's no longer an option. In that scenario, you can still deduct the cost of these 3 units as a repair expense. Just because it fails one test doesn't mean it won't pass another test and have another way of being expensed. Another common building component that gets a lot of attention with respect to repairs is the roof. KBKG wrote an article on expensing roofing costs that was published in the Tax Advisor, and I think you may find it helpful. The web address is posted on this slide, and the same restoration analysis that we discussed with respect to HVAC components applies to the roofing system as well. The roofing system falls into that 9th category. It's not one of the 8 systems like HVAC is, but it's in that 9th category of the building structure. It's apart from those 8 defined building systems. In order to assess whether a substantial structural part or major component has been replaced, it's helpful to just take a step back and understand the basic components that are found within a roofing system. So we're going to spend a few slides going over that. Most common roofing systems will fall into one of these 2 major types. The first type is a steep pitch roof assembly, which is most commonly found in residential rental properties. Many of us live in homes that have a roof that looks something like this. The major components of this assembly include 3 primary parts. There's the underlying roof deck, which in our picture is a wood deck that's supported by wood rafters. The next layer is the underlayment, which provides a waterproofing barrier and is sometimes referred to as felt or paper. The last layer is the roof covering, which can include various types of shingles, clay tile or concrete tile, slate, wood shakes, or even metal roofing systems. Now for low pitch roofing, these systems are more commonly found in commercial buildings, and they consist of 3 sections as well. The first layer is the roof decking, which is typically a corrugated metal panel that's supported by structural beams that could be wood or metal. The next layer is an optional insulation layer. Unlike steep pitch roofing systems where the insulation is below the deck in an attic space, low pitch roofing systems frequently include the insulation layer between the deck and the roof cover. The final layer is the roof cover or membrane. Once you understand what type of components you have and what the scope of the replacement was, then you can begin to apply the tangible property regulations to determine whether the work may be considered a repair expense or perhaps it should be capitalized and depreciated. The questions on this slide are going to help you discover the relevant facts, and then based on your experience, there are questions that you're going to be able to present to an IRS engineer because they're going to ask those as well. Why did the roof need to be replaced? If it was because of a casualty event and the taxpayer properly deducts a casualty loss by reducing the building's basis by the amount of the loss, the cost of the new roof must be capitalized. How much of each roof layer was replaced? Well, if only the outer roof covering, that's the membrane or shingles, were replaced, but none of the underlying roofing system, then it's not a restoration. If any load-bearing structural elements, including decking and sheathing, were replaced that support more than 40% of the roof, the entire cost is likely a restoration. If more than 40% of the insulation layer between the roof covering and the structural elements was replaced, it may be a restoration. Was the roof work part of a project to return the building structure to its ordinary operating condition after it had deteriorated to a state of disrepair and it was no longer functional for its intended use? In my experience, Most building structures can continue to function as intended with some degree of roof problems that could have minor leaks, exterior trim damage, but at some point, the disrepair of a roof becomes significant enough to impede the normal functions of the building structure, and the cost of the roof work must be capitalized as a restoration. A good question to ask here is whether we had to shut down the facility or stop production in order to replace the roofing system. Did the taxpayer claim a retirement loss or partial disposition deduction for any portion of the old roof? If so, the cost of the roof work is capitalized as a restoration. How much time elapsed between the building acquisition and the roof work? Generally, if roof work needs to be done soon after the building was acquired, say 2 years later, it might fall into the betterment category because the work corrected a material defect or condition that existed before the building was acquired. However, if a long period of time has passed since the original building acquisition, say 7 years, it generally won't fall into that category. What kind of roofing system was there before, and what kind was it replaced with? If improved materials were used, what was the life expectancy of the old roof, and what's the expected life of the new roof? Going from asphalt shingles with a 20-year life to clay tile with a 50-year life is going to be a betterment because they would materially increase the quality of the building structure. Were improved roofing materials used because comparable materials were no longer available or technology is advanced? You see, if it's not practical to use the old type of roofing system, it's generally not a betterment. The classic example here is wood shingles. Most parts of the country now don't even permit wood shingles. So if you're replacing an old roof that had wood shingles with an asphalt roof, it's not going to be, it's easily comparable. Did the roof work relate to a physical enlargement of the building? If so, the enlargement portion of the roofing system will need to be capitalized. Here are a couple of simple examples of applying the regs to roofing work. In our first example, X replaces 60% of the roof decking, insulation, and roof membrane. X replaced a major portion of the roof system, and so this is a restoration, and it must be capitalized. In the second example, Y replaces only the outer roof membrane and does so with a comparable product, so it's not a betterment. In my experience, a very high percentage of invoices for roof repairs can potentially be treated as a current year repair expense. The key is to ask insightful questions and then assemble the facts and circumstances so that you can evaluate the scope of the work that was performed. To this point, we've focused our discussion on repair versus capitalization. We're going to shift gears a bit and focus now on retirements and dispositions. The final disposition regulations were issued in August of 2014, almost a year after the tangible property regulations were finalized. The current rules allow the taxpayer to take a loss deduction when they remove anything from a building. So, for example, if you pay $50,000 to replace all the HVAC units in your building with new ones, well, you're going to need to capitalize that amount. The $50,000 is then recovered over 39 years. However, you can now figure out how much remaining basis is left in your old HVAC units and claim that amount as an immediate deduction in the tax year that the replacement occurs. This is considered to be a partial disposition and can only be done on a go-forward basis and in conjunction with a timely filed tax return. When these regs first came out, there was an opportunity to retroactively take advantage of this for late partial dispositions from prior tax years. That retroactive opportunity has long since expired, so if a taxpayer now fails to take advantage of a partial disposition opportunity in the current tax year, then they'll simply miss it and will have to continue to depreciate the original basis of the replaced component, even though that component is no longer there. Now, if you acquired an existing building and don't know how to calculate the remaining basis in a component of the building, you may want to take advantage of our partial disposition calculator found at the link here on this slide. We created this tool for that very situation, and it relies upon the producer price index in conjunction with other factors to estimate the remaining basis. We'll talk more about the calculator and how it works in a later slide. Let's look here at an example to see the impact that this can have. Suppose a taxpayer acquired a building in 2012 for $5 million. Later, in 2021, they spent $1 million to remodel a part of the second floor. They remodeled ceilings, walls, lighting, plumbing, ductwork, and electrical wiring. Now, suppose that KBKG analyzes the original cost of the demolished components and discovers that they represent $470,000 of the original $5 million building basis. The result then is the taxpayer can now, in 2021, recognize a loss of $404,000, which is the original cost basis of $470,000, less an estimated $66,000 of depreciation that's already been taken since 2012. Remember, as said on the previous slide, you can only take advantage of this partial disposition in conjunction with a timely filed tax return. Otherwise, you forego the opportunity to recognize the retirement. The reason retirements are significant is that they result in permanent tax savings. If you incorrectly continue to depreciate Section 1245 and 1250 property that was removed from a building, you will eventually pay recapture tax upon the sale of the property. We say incorrectly because the retirement rules indicate that you should take the disposition in the current year when the asset's disposed. The regs don't say you may, they say you should take the disposition. So if you don't, you're missing out on a benefit that was intended for you to enjoy. The permanent savings are the result of differing tax rates between 1245 recapture, which is at ordinary rates, 1250 recapture at 25%, and capital gains at 20%. And based on President Biden's tax plans, the capital gains may increase, but at least for now, these are the rates for 2021. To illustrate the permanent savings, let's look at our previous example where the taxpayer acquired a building in 2012 for $5 million and had the $470,000 in retirements in 2021. If the taxpayer had not taken the retirement deductions in 2021, they would have continued to depreciate that $470,000 until ultimately the property is one day sold, and then recapture would be required. Now, let's say that $370,000 of the basis was 39-year property and the other $100,000 was 7-year property. The recapture tax on the real property would be $370,000 at 25%, added to the $100,000 at 37% for the personal property, for a total recapture tax of $129,500. However, as a result of the retirement study, the recapture tax now goes to zero. There's a capital gain tax on the $470,000 at 20% for a total of $94,000. So you see the net difference between $129,500 and $94,000 is your permanent tax savings in this example upon sale of $35,500. Within the regulations, the IRS did include safe harbors for common repair items. Under the routine maintenance safe harbor, you're not required to capitalize as an improvement and therefore get to deduct amounts that are paid for recurring activities that you expect to replace more than once during the class life of the unit of property. For building structures and building systems, you must reasonably expect to perform the activities more than once during a 10-year period, beginning when placed in service. So in our example here, you expect to replace escalator handrails once every 5 years. So you've satisfied the routine maintenance safe harbor. Note that you don't actually have to replace the handrails once every 5 years. You just need to have a reasonable expectation that you would replace them every 5 years. If the amount doesn't meet the requirements for the routine maintenance safe harbor, again, you may still deduct the amount if the amount, but it would have to go through the normal bar test and pass the other criteria. In our example, we expect to replace an HVAC unit every 12 years, so it fails the routine maintenance safe harbor. However, it potentially could still pass the bar test and be deducted as a current year repair expense. Here's a great example of how the routine maintenance safe harbor benefited one taxpayer in a very significant way. In the left photo is one of 3 identical kilns that are used in their business activities. Each kiln is lined with refractory brick, which is similar to what you see in the photo on the right side. The taxpayer would shut down operations for 1 week in July to replace the refractory brick in one of the 3 units. Each year, the taxpayer would replace the brick in one of the 3 units on a rotating basis at a cost of approximately $300,000. They maintained excellent records showing this was done on a regular basis and were able to demonstrate that reasonable expectation that they would be replacing the brick more than once during the class life of the property. Well, one of the common elections that many have seen from these regulations is this de minimis safe harbor election. It's a safe harbor the IRS included since some items may be administratively burdensome to track. Under the final regulations, you can elect to apply a de minimis safe harbor to amounts that are paid to acquire or produce tangible property to the extent these amounts are deducted by you for financial accounting purposes. If you have an applicable financial statement, or AFS, you can use this safe harbor to deduct amounts paid for tangible property up to $5,000 per invoice or item. If you don't have an applicable financial statement, you may use the safe harbor to deduct amounts up to $2,500 per invoice or item. These limitations are for purposes of determining whether particular expenses qualify under the safe harbor. They are not intended as a ceiling on the amount you can deduct as business expenses under the code. The de minimis safe harbor election does not include amounts paid for inventory and land or materials and supplies the taxpayer is elected to capitalize. The de minimis safe harbor election eliminates the burden of determining whether every small dollar expenditure for the acquisition or production of property is properly deductible or capitalizable. If you elect to use the de minimis safe harbor, you don't have to capitalize the cost of qualifying de minimis acquisitions or improvements. However, de minimis amounts that you pay for tangible property may be subject to capitalization under Section 263 Cap A if the amounts include the direct or allocable indirect costs of other property you produced or acquired for resale. For example, you must capitalize all the direct and allocable indirect costs of constructing a new building. An applicable financial statement includes a financial statement required to be filed with the SEC, as well as other types of certified audited financial statements accompanied by a CPA report, including a financial statement provided for a loan, reporting to shareholders, or for other non-tax purposes. An applicable financial statement also includes a financial statement required to be provided to a federal or state government or agency other than the IRS or the SEC. Well, after the final regs came out in 2013, the National Retail Federation lobbied for recognition of the regular remodels that are performed on retail and restaurant properties to keep them competitive and up to date. As a result of their efforts, we have Revenue Procedure 2015-56. And this provides a safe harbor for these taxpayers that meet the defined criteria. Generally, the safe harbor benefits those that are enhancing the physical appearance and layout of their buildings in order to maintain an attractive environment for their customers. The safe harbor allows 75% of qualified amounts to be deducted as a current year expense, and the remaining 25% is capitalized. In addition to the obvious tax benefits, it also relieves some of the burdens of evaluating a unit of property and tracking assets on a depreciation schedule. In order to qualify for the retail restaurant industry safe harbor, the taxpayer must have an applicable financial statement. If the taxpayer is in the retail business, they must be in the trade of selling merchandise, including goods to resellers, such as warehouse clubs and home improvement stores. Certain types of retail activities are excluded, including automotive dealers, other motor vehicle dealers, gas stations, manufactured home dealers, and non-store retailers. If the taxpayer is a restaurant business, they must be in the trade or business of preparing and selling meals, snacks, or beverages to customer order for immediate on-premises and/or off-premises consumption. Certain types of these restaurant activities are excluded, including hotels and motels and the others listed on this slide. The idea here is their primary business activity should be that of a restaurant instead of these other types of activities. And I would point you to our link there for the KBKG Insight article. Here's a list of what's not considered qualified property that's eligible for this special safe harbor. All of these items must first be removed from the total cost before calculating the 75% that is deducted as a current year expense. Notably to me, Section 1245 property is on this list, so the 5-year recovery tangible personal property gets identified separately, leaving only the non-residential real property included in this safe harbor calculation. The analysis is probably not as simple as you might have thought when we first brought this up, but for retail and restaurant taxpayers, it's potentially a very, very valuable tool that should be given careful consideration. I also want to note that the Audit Techniques Guide related to capitalization of tangible property here, I mentioned it earlier. In March of 2012, IRS examiners were instructed in an LB&I directive to discontinue examining issues involving whether costs incurred to maintain, replace, or improve tangible personal property, or tangible property, excuse me. With the release of the final tangible property regulations in 2013, the disposition regulations then in 2014, and then finally the Audit Techniques Guide in 2016, we really have everything in place for potential audits related to the tangible property regulations. And I'm not sure what people's experience is with that in the audience, but everything's there for an audit to be done. There's plenty of guidance, in other words, to understand what the rules are and how to go about doing the audit. How can KBKG help? Well, prior to the tangible property regs, we would have said, let us help you with any missed cost segregation opportunities, and these are often discovered during a comprehensive fixed asset review. Over these years, we've become very good at also identifying the opportunities to take advantage of those retirements and dispositions. And when scrubbing through a fixed asset list, we usually turn up lots of assets that have been misclassified. We also see opportunities to expense costs that were previously capitalized, and we see assets that were eligible for bonus depreciation where taxpayers didn't intend to elect out, just failed to claim the bonus. We can prepare the 3115s, or we can help tax preparers get them ready for their clients. The software solutions that I mentioned are on this slide and may be of use with respect to the topics that we've covered today. They're available at the web link that's listed there. If you've never been to our solutions page before, once you're there, you'll need to create a profile with a username and password in order to log in. And of course, there's no charge to do that. Once you've logged into our solutions dashboard, you'll see the tools listed on this slide. And you'll notice the partial disposition calculator we referred to earlier, for example. We have other webinars that go into detail about how to use the software tools. So if you have any questions or need help gaining access, feel free to reach out to me.
This concludes our CPE portion of the presentation. If you're interested in engaging with people, I encourage you to look into our business development team, who is looking for CPAs or tax staff seeking a career that utilizes your social skills. Find out more at https://www.kbkg.com/careers. Thank you and have a wonderful day.